In this video, we are going to reveal the best ETFs for European investors for 2025 across each of the four most popular ETF categories: S&P 500, All World, Europe, and Emerging Market ETFs. And no, they are not with Vanguard. We'll also have a fifth bonus category at the end of the video exclusively for advanced investors. For each category, we'll reveal both the best dividend-paying and non-dividend-paying ETFs for Europeans for 2025, starting with the best S&P 500 ETFs. The SPDR S&P 500 UCITS ETF is an accumulating ETF with a total expense ratio, or TER, of 0.03%. Accumulating means that the ETF will reinvest any dividends it receives by buying more shares in the companies which make up the index that the ETF is tracking. In this case, the S&P 500 ETF will use the dividends received from companies in the S&P 500 index to buy more shares in those companies. As a result, the ETF will have a higher net asset value, or NAV, which in turn increases the value of the ETF's shares for shareholders. You will not receive a cash dividend from accumulating ETFs. This can be beneficial because in many countries, like Ireland, investors won't have to pay tax on the dividends that are reinvested by the ETF. This particular ETF has a total expense ratio, or TER, of 0.03%, which means that for every €1,000 invested, 30 cents will go to fees. This is effectively the yearly cost of owning the ETF, not to be confused with the fees charged by your broker for purchasing the ETF, but more on that in just a second. High TERs negatively impact investment returns, and so ideally, we want our TERs to be as low as possible in each ETF category. You can find this ETF using an online broker by typing in its International Securities Identification Number, or ISIN. In this case, IE 000XZSV718. As is the case with many ETFs, the SPDR S&P 500 UCITS ETF has a sister ETF, which is a distributing ETF as opposed to an accumulating ETF. With the distributing ETF, the ETF will pass on the dividends that it receives from companies in the S&P 500 to the ETF shareholders by way of a cash dividend. In this case, a cash dividend will be paid out every quarter or every 3 months. But watch out, this cash dividend typically will be taxable as part of the investor's income. This ETF's TER is identical to its counterpart at 0.03%, which, by the way, is currently the lowest TER for both accumulating and distributing S&P 500 ETFs in Europe as per justetf.com. This makes these two ETFs the cheapest to own in the S&P 500 category. The distributing ETF's ISIN, to find it using an online broker, is IE 00B6YX5C33. Speaking of online brokers, the broker who will have all of the ETFs that are mentioned in this video available for you to invest in right now in one place is Trade Republic, which is why they are my top pick broker for Europeans investing in ETFs. Now, if you live in the UK and Trade Republic isn't available, then Trading 212 is a competitive second choice, as it will have most but not all of the ETFs that we cover. Both Trade Republic and Trading 212 will allow you to invest in ETFs for no fees and charges. In actual fact, for European investors, it could be a good idea to use both Trade Republic and Trading 212 to invest in ETFs for three main reasons: greater coverage under European protection schemes, greater selection of investable assets, and greater flexibility and choice around fees and charges. But as I said, Trade Republic does have a better selection of ETFs available for European investors than Trading 212. So if you do want to invest in any of the ETFs covered in this video, you can set up an account for free with Trade Republic and Trading 212 by using the links in the video description and pinned comment in the comment section. But getting back to our ETFs, both of these SPDR S&P 500 ETFs utilize full replication, a form of physical replication, to provide investors with the returns of the S&P 500 index. This means that the ETFs physically own the stocks comprising the S&P 500 index. However, However, both of the SPDR S&P 500 ETFs offer a unique and valuable advantage over certain other physical replication S&P 500 ETFs. You see, these ETFs are domiciled in Ireland, which essentially means that these ETFs have been set up in Ireland. You can actually identify an ETF's domicile by using the ETF's ISIN, as you'll notice that the first two letters are IE for Ireland. This would be LU for a Luxembourg domicile, FR for a French domicile, etc., etc. But here's the secret. Because of Ireland's unique tax treaty with the United States, an Irish domiciled ETF is only subjected to US dividend withholding tax on the US dividends paid to the ETF at a special rate of 15%. In comparison, an equivalent Luxembourg domiciled ETF will be liable to US dividend withholding tax at a rate of 30%, meaning investing in an Irish domiciled S&P 500 ETF, like the two SPDR ETFs that we've just mentioned, means more dividends received by the ETF, which in turn means greater returns for investors. So those are my two main picks for the S&P 500, and towards the end of the video, I'll tell you how you can access a spreadsheet which contains all of my top picks for 2025 for each ETF category. Moving on to the best all-world ETFs. The Amundi Prime All-Country World UCITS ETF is an accumulating ETF with a TER of 0.07%. The ETF's ISIN is IE0003XJA0J9. This ETF provides exposure to the companies contained within the selective GBS Global Markets Large and Mid Cap Index. This index comprises 3,433 companies, accounting for approximately 85% of the total value of the global stock market. Its sister ETF, which is a distributing ETF, can be found under the ISIN IE0009HF1MK9. Again, the TER is 0.07%. These two ETFs have the lowest TERs for all world ETFs on just ETF.com, making them very competitive from a cost perspective. But it's important to note that cost isn't always the sole factor to consider. For example, different all-world ETFs provide exposure to different all-world indexes. The selective GBS Global Markets Large and Mid Cap Index is just one of many all-world indices. For example, you also have the MSCI ACWI and the FTSE All-World Indices. They're still all-world indexes, they just offer different levels of coverage. For example, the MSCI ACWI index has 2,647 constituents, whereas the FTSE All-World Index has 4,247. ETFs such as the SPDR MSCI ACWI UCITS ETF and the Invesco FTSE All-World UCITS ETF will provide you with exposure to these indices for TERs of 0.12% and 0.15% respectively. What you'll commonly find, particularly for indexes like FTSE All-World, which contains over 4,000 stocks, is that the ETFs tracking these indices won't physically own all of the companies contained within the index. Instead, they'll use either sampling or optimized sampling to pick a representative sample of the index as opposed to full replication. This can be seen with the Invesco FTSE All-World ETF having 2,396 companies and the Vanguard FTSE All-World ETF having 3,644. The potential upside of owning a representative sample of the index as opposed to the full index components is the minimization of trading fees at the ETF level, and in theory, providing investors with returns that are more aligned with the index return. However, the potential downside of sampling is providing investors with returns that actually deviate from the index. In either case, the two ETFs that we've picked from Amundi use full replication to provide investors with the index return and not sampling. But the one thing that every all-world ETF has in common is an outsized weighting towards US companies, comprising over 60% of most all-world indices. With the Amundi ETFs being Irish domiciled, this again means that investors will benefit from these funds receiving dividends from US companies at 15% dividend withholding tax. Regardless, all-world ETFs are heavily weighted towards US companies. Certain investors may prefer to instead own an S&P 500 ETF, as well as an ETF from each of the next two categories in order to simulate an all-world ETF, with the benefit of greater flexibility because you can decide how much exposure you have towards the US, Europe, and emerging markets. That brings us on to the best Europe ETFs. Again, the two ETFs that we've selected here are from Amundi, but this time with a notable difference. The first is the Amundi Prime Europe UCITS ETF, an accumulating ETF with a TER of 0.05%. The ETF ISIN is LU2089238039. Its sister ETF, which is a distributing ETF, also has a TER of 0.05%. The ETF ISIN is LU19319746262. Both of these ETFs track the selective GBS Developed Markets Europe Large and Mid Cap Index, which provides exposure to 85% of the value of the developed European market. As was the case with all world ETFs, you have a number of European indices and corresponding ETFs to choose from, including the Stocks Europe 600, MSCI Europe, and FTSE Developed Europe indices. Both of the ETFs from Amundi will provide you with European coverage at the lowest TERs as per justetf.com, and with full replication of the index. You might have noticed that these ETFs are domiciled in Luxembourg and not Ireland, as indicated by the presence of LU in the ETF's ISIN. We've already talked about why we prefer Irish domiciled ETFs when we're getting exposure to US equities, but in this case we're talking about European companies, and the tax treaties that are held by both Ireland and Luxembourg with other European countries where these companies are based are largely the same, meaning there is no comparable dividend withholding tax advantage of Irish domiciled Europe ETFs as composed to Luxembourg domiciled Europe ETFs. This is why these two ETFs from Amundi are my picks for Europe ETFs. The last of our four main categories of ETFs before our bonus category is the best emerging markets ETFs. For the first time, the two ETFs that we've gone with aren't provided by the same asset manager. For the accumulating ETF, we've gone with the Amundi Prime Emerging Markets UCITS ETF, which has a TER of 0.10%. ETF ISIN is LU23002951123. This ETF provides exposure to the selective GBS Emerging Markets Large and Mid Cap Index, which covers 85% of the value of the emerging markets, equating to 2003 companies. Again, the Luxembourg domicile doesn't make a material difference here. For the distributing ETF, we've gone with the HSBC MSCI Emerging Markets UCITS ETF, which has a TER of 0.15%. The ETF ISIN is IE00B5SSQT16, which of course means that it's an Irish domiciled ETF. This ETF provides exposure to the MSCI Emerging Markets Index, which covers 85% of the market capitalization in each emerging market country, equating to 1,252 companies. For both the Amundi ETF and the HSBC ETF, full replication is used to track each index. Other ETFs, such as this ETF from iShares, provides exposure to indices like the MSCI Emerging Markets IMI, which offers 99% coverage of the emerging markets. This comes at the cost of a higher TER. So the question for you is whether the additional coverage is worth the higher TER, considering that the additional companies would have a fractional impact on the ETF's performance given their negligible weightings within the index. This is because these companies represent the bottom 14% of companies in the emerging markets by value, and as we know, the lower the value of a company relative to the index, the lower its impact on index returns. Regardless, the two ETFs from Amundi and HSBC are my picks for the emerging markets. That brings us on to our bonus category topic for advanced investors: synthetic ETFs. Now, I have a full video explaining in detail what synthetic ETFs are, and you should absolutely check that out because I'm not going to be covering the basics here. All I want to mention is that for many of the indices that we covered, there are synthetic ETF options available, which in theory could be better choices than the physical ETFs that were highlighted above. For example, for the S&P 500, we have the Amundi S&P 500 II UCITS ETF with a TER of 0.05% and an ETF ISIN of LU11358658084. This is an accumulating synthetic S&P 500 ETF. Yes, this is an S&P 500 ETF with a Luxembourg domicile. And earlier we said that we explicitly prefer Irish domiciled ETFs for US equities due to lower dividend withholding tax. However, because synthetic ETFs use financial derivative contracts known as swaps to provide investors with the index return, they fall under scope of Section 871M of the US Internal Revenue Code and are exempted from US dividend withholding tax entirely, provided they relate to a qualifying index. Therefore, the Luxembourg domicile actually doesn't matter in this case because the dividends will be exempt from US dividend withholding tax anyway. What this means is that in theory, synthetic S&P 500 ETFs have the capacity to generate higher returns for investors than their physical counterparts, primarily due to the fact that they're receiving 100% of the value of US dividends. This was found to be true in datasets analyzed by Invesco and Vanguard. However, it's not just the US dividend withholding tax exemption that determines over or underperformance versus their physical counterparts, but rather the net effect of the dividend withholding tax exemption, TERs, swap fees, and tracking errors, among other factors. Coupled with the complexity of synthetic ETFs to begin with, this is why I often say that for the average investor, the juice of synthetic ETFs isn't always worth the squeeze. But for those who want to optimize their ETF investments as much as possible, they are certainly worthwhile looking into, and I would highly recommend checking out my full video on the topic. The same concept further extends to synthetic all-world ETFs, as over 60% of all-world indices relate to US equities. Even synthetic Europe ETFs, like the Invesco Stocks Europe 600 UCITS ETF, an accumulating synthetic ETF with a TER of 0.19% and an ETF ISIN of IE00B60SWW18, benefit from tax advantages over their physical counterparts. This is because synthetic Europe ETFs further benefit from avoiding stamp duty on UK equities and a financial transaction tax on Italian and French equities. Of course, synthetic ETFs tracking an all-world index would benefit from all of these tax advantages simultaneously. But to be clear, my picks in the four main categories remain the same for the average investor. Synthetic ETFs are only for those who are willing to put in the extra time that is needed to understand what they are, how they operate, and whether they have the capacity for greater returns. You can find a link to a spreadsheet in the video description which contains all of the ETFs that were discussed in this video. If you want to invest in any of these ETFs, then you can sign up for a free account with both Trade Republic and Trading 212 using the links in the video description and pinned comment in the comment section. Using these links as opposed to downloading directly in the App Store supports me as a creator and lets me know that you found this video to be useful. Let me know, what did you think of my list for the best ETFs for European investors in 2025? Did I miss any contenders, and what ETFs are you investing in this year? Leave a comment down below. Thanks very much for watching, and I'll see you in the next one.